Hey guys, what's going on? Jay here from smarthelping.com. I'm going to talk about how to do a discounted cash flow analysis for investors' equity based on cash flow per period. Pretty common thing that comes up in most financial modeling scenarios, but it's actually quite difficult to do. There's a lot of different ways to do it. Today, I'm going to talk about the way, the manual way. Before I get into it, don't forget, check out more smart help or more financial models at smarthelping.com. I've got all kinds of sheets and spreadsheets and templates and calculators here for all kinds of different businesses, full financial models, SaaS, real estate, industry-specific models, all kinds of stuff here. You can get everything for $9.99, or you can buy individually or by bundles. If you do any bundles, you do have access to those for life, and any templates that are added to that. Okay, let's get back into the sheet here. So I've already built out this a little bit. I'll have the link in the description box below. It's just a free template. But here's how it works. So in your financial model, you'll have revenues, expenses, other cash flow items, and you'll have some final calculation that says, here's the cash flow that's going to happen with the business operations per period. And now, if it's obviously you're going to need some investment. So what what I've done here is I've linked up the running cash position to the equity contributions and distributions. And then these are going to drive the final discounted cash flow analysis, which I haven't done yet, and I'll show you that live, or not live, but in here. Okay, so what I say is, well, period zero, we're going to need $500,000. So we put $500,000 in the contributions. There it is. And now look, balance running cash position is above zero. That's what we want. Here we got a $5,000 outlay, $5,000 outlay, and so forth for a couple months here. Then we have some positive cash. So we can choose to distribute this and put 25,000 down here. And then you can see running cash position goes back to zero. And I could distribute this all of these times. Running cash goes to zero. I could continue doing this. And then, oh, here I need 650,000. So now I got to contribute money back in. And you can see how it works. If I were to have not distributed this, then my actual contribution here to get the cash above zero would have been less because I could have used this working capital. Now I got next month 13, we've got 120,000 left. I could say, okay, let's distribute that. Whoop, 120,000. Then I say, well, let's build up some working capital. We got 120 here. We got some negative months, so I'm not going to do anything for a bit. Just saving up some capital. Now here we've gotten over 500,000. Well, maybe we do some distributions. Let's say, you know, we could distribute more than what the month is. We could say, well, let's distribute 300,000. And we could distribute another 100,000 here. So this is a manual way to just affect the cash flow based on, and you can make sure it doesn't go below zero based on whatever the model's putting out for the cash per period. And we go here and then look, we still got lots of cash, lots of cash. We have another outlay 128, but we still have plenty of left, so we're not going to need any contributions. And then at the end, you could actually just distribute the rest of it, whatever it might be, and you go back to zero. Okay, so that's a pretty simple structure on how to solve something that's pretty complex. Your running cash position is your target that you're trying to keep at zero. Now, to do the discounted cash flow analysis, well, we say the investors, we say it equals, well, let's do cash flow investor. It would be negative this amount plus this amount. And there is the cash flow per period. So they're getting these amounts back that are here. They're contributing these amounts. And you can see why it's not necessarily going to follow the cash flow of the business, because you have multiple periods where you have positive cash flows, potentially negative cash flows, and you might want to, get the money from investors maybe all up front or for 4 or 5 months in advance to cover these cash outlays. So that's why, you could just run an IRR on your numbers here in the cash flow of the model, but that might not be what you're actually requesting from investors. So you then go to this logic here. And let's put a thick bottom on this. Right. So I can do a simple, so monthly IRR, and then we'll convert it, would be here. We'll also do just kind of cash flow analysis. Now remember, the IRR is what you have to discount the future cash flows at to reach a 0 net present value. So they're connected. My annual IRR is, let me see if I can remember how to convert this. I believe it is 1 plus the rate. Let me think. Raised to the number of periods minus 1. Can't remember if that's it. We'll know in a second. Actually, no, we have to check this. Let me just check it real quick so I could look at one of my real estate models here and see these templates. This one has the conversion. Let's see if I did it right. I don't do these conversions a whole lot. So we want to go monthly to annual. 1 plus the rate raised to 12 minus 1. Oh, nice. I did it right. And then going from annual to monthly, do 1 plus the rate raised to 1 over 12 minus 1. Okay, that's good. Let's make sure I got the syntax right. So let's copy this over. I just want to make sure it matches. And we'll just replace this with our rate 39.8. Nice. Okay, good. I got it right. So there's our annual IRR. And then to do the discounted cash flow analysis, all you need is a discount rate. And let's say here's our discount rate. Now this is a monthly. So we're discounting these periods. Well, I'll just show you. So we'll say present value of cash flow. We simply take the amount, so cash flow from investors, this amount, and it's going to be divided by 1 plus the rate, discount rate, raised to the period we are in. And I need to lock C. And now that should give me the present value of all the future cash flows. And you can discount negative future cash flows. That's completely fine. And so we sum all this up here. Now remember, these are monthly. So this is not an annual discount. So this discount rate, you have to convert it again. Let's say this is the, if this is the annual discount rate, we'll make this black, then the actual discount rate we apply is same deal. We got to convert it from a annual rate to monthly. So we go here. Let me do the brackets. 1 plus the rate raised to 1 divided by 12 minus 1. So to discount something at 4% per year, it would actually be discounted 0.33% per month. So let's go down to that. And yeah, that's a bit higher because that's only 3 years, not 36 years. And then net present value, we just sum up the total value of all of the present value, of all the cash flows, and there it is. Now, what happens if we take this annual rate and plug it into here? It should be close to 0. It is 0, so we've done all the math right, all the conversions. How close is this to 0? Yeah, that's exactly 0. There's a little bit of rounding there in Excel, but that's fine. So yeah, when you're doing this, you got to make sure what period are you compounding? Is it annual or monthly? Here in this case, we're doing monthly. And then if so, you got to convert your internal rate of return from monthly to annual with these formulas. Discount rate has to also be discounted to monthly, whatever the annual discount rate is. And that's it. So I'd say this is actually a really helpful template for a lot of people. Enjoy. Don't forget, check out www.smarthelping.com for more. I've got hundreds of financial models, templates, and tools. Check it out.